If you ever wish that you could lock in your DeFi yield the same way that bond investors lock in a fixed rate, that's exactly what Pendle Finance lets you do. It's truly one of the most innovative protocols in DeFi right now, and I think it deserves a closer look. In this video, I'm going to cover what Pendle is and why it's unique, exactly how it works in plain English, the strength of the team and the community, a couple of the risks that you might want to know about, and how Pendle fits into my own risk portfolio. And then finally, I'll walk you through some of the current yield opportunities that I see on the platform right now today. By the end of this, you'll know exactly why Pendle has earned a place in my portfolio. At a high level, Pendle is a marketplace that splits your yield into two different pieces. There's a principal token, known as PT, and it's kind of exactly like buying a bond at the discount and then getting a fixed yield that you hold until maturity. And then there's the yield token, the YT. That's the floating part. You're betting on how much yield the asset throws off over a period of time. So instead of being stuck with, whatever the protocol pays you, Pendle lets you separate and trade both of those parts. So if you want stability, you buy the principal token, the PT, and you hold it. And if you want the upside to yield volatility, you buy the yield token, the YT. And both tokens stay liquid thanks to Pendle's automated market maker, also known as an AMM. What makes Pendle unique is that most yield strategies are bundled together. You can't choose the fixed versus the variable. Pendle unbundles them and makes each leg of it liquid. That's the magic that Pendle unlocks. You can lock in a rate on a stablecoin yield the same way a fixed investor does with bonds. Or you can speculate on yield spikes from rewards or point programs. And because Pendle has its own AMM, you're never locked in. You can kind of rebalance at any time. So here's how all this works without all the fancy jargon. Number one, you start with a yield-bearing asset, say a staked stablecoin, or a liquid staked token. Number two, Pendle then wraps that token and then splits it off into PT, the fixed yield, and YT, the variable yield, each with a maturity date. Number three, you can then buy the PT to lock in a fixed rate. You can buy the YT if you think the variable yield will be high, or you can provide liquidity in Pendle pools for fees plus the incentives. Lastly, number four, under the hood, VE Pendle gauge system directs emissions to the pools, which is why some markets have really nice looking APRs. Think of it like this. PT is your bond at a discount. YT is the coupon float. And what that means in practice is that if you hold the principal token until its maturity, you're effectively locking in that fixed APY. You know exactly what return you're going to get. If you hold the yield token, the YT, your outcome will depend on where those yields go. If the yields rise, your YT becomes more valuable. If those yields fall, it's worth less. Let's talk about the team and the community. Because Pendle isn't an anonymous project. It was founded by T.N. Lee, who is publicly known and often represents the protocol in things like interviews, AMAs, and conferences. The project was incubated by Lemniscap and has backing from other established VCs. Having a visible founder and a professional team adds credibility in a space where so many projects are built anonymously. On top of that, the community is one of Pendle's biggest strengths. Especially with Pendle Intern driving a lot of that traffic on X, and the combination of a transparent leadership team and a diehard community has been a huge part of Pendle's staying power across multiple market cycles. Pendle hasn't had a major exploit or any sort of blow-up moment that wiped out users. But there are a few kind of nuances and things that are important to understand. First, liquidity clusters around maturity dates. Here's basically what that means. As principal tokens get closer to maturity, the discount you buy them at starts to shrink. So in other words, the fixed yield gets smaller and smaller. At the same time, the yield tokens get more volatile because all that's left is the uncertain stream of yield between now and that maturity date. So if you don't plan for that dynamic, you could potentially be caught off guard by how quickly price changes as those dates approach. Second, incentive rotates constantly. Pendle uses their gauge system where emissions are directed by VE Pendle voters. Add that to the fact that some partner rewards or pools have deposit caps, and you end up with markets that can look incredibly attractive one week and fill up super fast and taper off the next. So if you're allocating there, you just kind of need to understand that the reward landscape is super dynamic. It's not really a set and forget strategy. And third, there's the issue of composability risk. Pendle itself is a smart contract layer on top of another yield-bearing asset, which itself might be staked in a protocol. So you're effectively stacking risks: the base asset, Pendle's wrapper, and the AMN infrastructure that trades it all. If something fails at any of those layers, your position could be exposed. It certainly doesn't mean I would avoid it. It just means that I size my allocations with that risk in mind. So while Pendle has a super solid track record so far, it's not without its moving parts. Knowing these dynamics is definitely key to making successful investment strategies. So how do I grade Pendle? I give it a solid A-. It is innovative, liquid, and community-driven. The minus is only for rotating rewards and caps, which make it a little bit tricky for some newcomers. But for shaping yield exposure, it's absolutely best in class. So where does it fit in my overall portfolio framework? At the low to low medium risk side, I think of buying principal tokens, or PT, on high quality stablecoins. These behave a lot like bonds. You buy them at a discount, and as long as you hold them through their maturity date, you know what you're going to get back. It's predictable, it's steady, and it fits really nicely into the capital preservation part of my portfolio. The main risks here are contract risk and the quality of the underlying stablecoin. But from an economic perspective, it's as close to fixed income in DeFi as it gets. In a medium risk bucket, I put liquidity into Pendle pools. This can be super attractive because you're earning swap fees plus the incentives, and then sometimes those APRs are really good. But here's, I guess, the one thing to know. Returns depend on how those yields move and then where the incentives flow. If emissions rotate away or if the market shifts, the return profile can change really quickly. So while I like providing liquidity, I keep my position sizes reasonably and I check them often. It's a solid tool, but it's not one that I totally overweight in my portfolio. And then there's the high risk side. That's where the yield tokens, the YTs, come in. This is the speculative part. When you're buying YT, you're essentially betting that yields will stay high or even spike higher. And when you get it right, the returns can be fantastic, phenomenal. But when you get it wrong, you can lose value quickly because your token is tied only to that variable yield income stream. I think YT can be powerful for a speculative part of the portfolio, but for me personally, it really doesn't fit into my capital preservation first strategy. So I tend to focus more on the principal tokens and providing liquidity. So let's take a look at some of the pools that are actually active and markets that are active on Pendle right now and available to us. So right here we can come to markets and we can kind of see here, we can just play around. These are all the different markets here. We've got Optimism, we've got Sonic, we've got all these different places. I particularly invest mostly in either Ethereum, Base, and Arbitrum on these, but there are some really great categories here. And then if you want to take a look and just put them by stables, you click right here and you put them by stables here. And so now you've categorized them by stables. You can take a look at the best YT, that's the best yield leverage, the yield token leverage position, and the best fixed APY here, which is generally the category that I pay most attention to. We're going to take a look at Ethereum, Base, and Arbitrum just for our purposes today, and we can just see here I've categorized it by best fixed APY, and we can see Falcon Finance's USDF is a token that I've covered here on this channel, and we've got 89 million, almost $90 million in this. We've got 4 different markets here, but essentially the fixed yield here is 45%. USDF is a higher risk stablecoin, so I would risk only 2.5% tops of my portfolio in it here, but at 45% fixed yield, this is something that I'd be very, very interested in taking a look at. ALUSD is Alchemix's stablecoin. This is again another high risk stablecoin. This vault's managed by Almanac, and it's got 15 million in here, and 23.88% is what they're paying in fixed. Let's take a look at USD AI is another really interesting stablecoin that I've covered on this channel. Got 100 million in here, total liquidity in here, 24-hour volume is 7 million, and it's paying 23%. YoUSD is I don't know if it's one that I've covered, but it's another higher risk play. Again, these are all plays that I would only put 2.5% in, but look at these yields here are really, really nice yields. If we go down just a little bit, you can see Resolve's USR is in here. This is a smaller pool here, but still sizable, and it's got 17.9%. If we go all the way down here, we can see here Super USDC is a USD vault, paying 11% fixed. So I mean, all these vaults are great options. We've got mostly some higher risk stuff here because that's what's paying the big old rewards, but Pendle is a great place that you can play around with some higher risk plays and get a fixed yield on, which I really, really like. And then we can take a look at the pools here. We talked about providing liquidity in these pools. We can take a look at the same 3 chains that we were talking about before. And we can look at our best LP APY. So LP is liquidity provision, right? And so we can see here, we can go here to stablecoins again. So we've got all the stablecoins. Again, we got that Falcon Finance USDF here paying 51% in a pool. We've got Syrup USDC, which is an actual medium risk play. A really, really solid stablecoin paying 36.1%. USDS, which is practically a low-risk stablecoin for me, but it's not quite there, paying 28% here. These are not fixed rates like we saw with the markets page. These are variable rates in these pools, but these are really, really healthy APYs. Again, we got ALUSD, which is Alchemix's stablecoin here at 26.39%, USDAI at 23.7%, and we can keep going down. USRs in here, Athena's USDE is paying almost 20%. And so this is, again, just goes to show you how deep Pendle is and how ubiquitous it's becoming within DeFi in terms of having it in your stablecoin portfolio. USDT down here paying 14.5%. Aave's Go paying 14%. Staked USDE, you can stake your Athena's USDE, which earns you fees, and then you can earn an additional 13.58% here if you put it in this liquidity pool. Phenomenal stuff here from Pendle. Pendle gives you options. Lock in a predictable yield with PT, take a calculated swing with YT, or provide liquidity and earn fees. For me, it's not about chasing the highest number, it's always about balancing income with risk. I'll keep sharing how I use tools like this in my own portfolio, so let me know in the comments which protocols you'd like me to break down next. And if you want to stay ahead with weekly insights, including updates to my own portfolio, make sure you subscribe. It really helps others discover the channel as well. This video is for educational purposes only. I'm sharing my personal approach. Nothing in here is financial advice. Always do your own research. Remember that crypto is inherently risky, and even stablecoins carry risks. Never invest more than you can afford to lose.